Good day. My name is Sam Radwan, founder of Enhance International LLC. We are an insurance industry consultancy, and we have been in the China market for over 13 years. It is a true pleasure and honor for us to present to you our view on lessons learned from the US non-auto market and how China can learn from it and benefit from it. If you look at the history of the insurance industry in the US, it is a long history. Insurance was present ever since the founding of the new republic. And it was Benjamin Franklin in 1752 who started the first insurance company in the US, selling fire insurance. As you can see, auto insurance only came about several years, hundreds of years later, when the actual vehicle became common in the streets of the United States. But non-auto products in general have been around in the industry for a long time, including small commercial, life insurance, accident and health, and other type of similar businesses. We also see how insurance evolves with new technologies like the internet and the cloud through cybersecurity, and also major events like the 9/11 attacks, with the first policy sold in the area of terrorism insurance. But also since the COVID crisis, business interruption products were available for a very long time in the US, but they now have become almost ubiquitous in every small commercial or commercial policy that is now being sold and is a very, very popular product. So what does the future hold? We are very well aware how environmental protection, or ESG in general, has taken front stage in the political scene, not only in the US and in Europe, but also in China as well, which is leading the world as it relates to environmental concern and sustainability growth, and moving to electric vehicles as an important means to do so. So we see that ESG now has become a major component of the coverage that you get in what is called directors and officers insurance for executives of publicly held companies. Cloud insurance is another product that the insurance industry is keeping an eye on. There is a startup that has come to market and is providing such a product for cloud interruptions, coverage for cloud interruptions. And the market is waiting to see what the results are in terms of appeal in the market, but more importantly, profitability. Another product that has been tested now for an extended period of time with insurance companies in the recent past is the whole idea of the liability that is presented by an AI decision or machine decision that may end up causing harm, either physical harm as it relates to, say, a smart car, or reputational harm, or as it may relate to a liability associated with something like that. We believe that these products are going to become very popular. However, insurance companies are being very, very careful in terms of understanding how to roll out a product like that and how to see to it that they have a good understanding of the risk exposure when they sell a product like this. Social media is another social and technological force that we see not just in the US, but in most markets around the world. You now are seeing coverage for reputational harm that may be caused by companies or individuals using social media and may end up getting sued or canceled, etc., and being able to get coverage for such type of an event. A company like Berkshire Hathaway, their new small commercial business, is now selling this product to most of to their existing clients in small commercial. And finally, another example is more of a social major event that is a big issue in the US these days, which is the whole idea of sexual harassment or discrimination based on race or other factors, is something that clearly the US is showing a lot less tolerance around. Therefore, a product of employee liability to protect the owners of the business or executives from the liability that they may face in terms of mistreating their employees is a product now that is also becoming very, very common as a new product that we will see more in the future. So it's clear to see that while in China, most of the property and casualty premiums right now are in motor insurance, in the US, it's a different story, where actually non-auto is a big component of the personal lines, specifically in the area of homeowners and renters, but also commercial insurance, right, is almost half the pie as well. So auto insurance, while a very, very big component of the property and casualty business, is not by any means in the majority. It's actually in the minority in the US. If we look at claims around the world, and if we factor in inflation, so in today's pricing, even factoring in today's pricing, what is clear to see that losses that insurance companies have to pay out is on a steep incline. What is also interesting to see here is it is not necessarily man-made events that is the dominant factor as it relates to claims payment. It's actually weather-related events that are the dominant component of the rapid increase in losses being paid out to consumers. So with the current climate issues or environmental issues that we're witnessing around the world, it's not surprising to know or to expect that this will only continue and this will only worsen. So what does that mean? What does that mean, or what conclusions should we derive from it in the China insurance market? I think the most important thing to derive from this is getting into the non-auto business, especially when we're talking about commercial insurance or property insurance. Okay? Managing profitability of the product or the business is going to be much more critical. Chasing market share with non-auto products is much more risky than in, say, motor insurance. And it is critical to see to it that when you approach these type of products, that you prioritize profitability over market share. If we slice the commercial business further, what is clear to see here is not only is small commercial the dominant and the largest component of the overall commercial picture or the commercial pie, but it's also the fastest growing. And in our view, this is going to be no different in China as well. China is a very dynamic market that strongly encourages entrepreneurships and encourages a lot of implementation of newer technologies. So much so that China now is becoming ahead of the game in relation to a lot of other organizations, countries in the world in adopting newer technologies like electric vehicles, etc. That we believe that the opportunity for insurers as well is going to be significant in the area of small commercial, not only in terms of volume or revenue, but also in terms of profitability as well. But let's go back to the point that we made and we want to re-emphasize is the focus on profitability and the focus on understanding the risk exposure of the non-auto business, especially the commercial business. This is a lessons learned from the US that is by far considered to be the largest ever payout in claims of any product, of any industry in the insurance world. And this is related to the material asbestos that was in the 70s and 80s was used heavily as an insulator between walls during the construction of buildings. But later on, it was found that asbestos releases this toxic material that can be inhaled and breathed in that's very toxic and cause a lot of health complications. So because the way the policies were written and because of how popular this product was, the insurance companies ended up paying a very, very heavy price in terms of losses that they're paying out till this very, very day. And this is a huge lessons learned that I believe the US market has paid a big price, but has learned from. And how do we see that? Well, let's take an example of a major crisis like the COVID crisis. A lot of businesses were shut down, and a lot of these businesses had a business interruption product that they may have purchased from because of their ability to be more targeted in terms of the type of product design that they had in place and the limits that they put on the losses. Insurance companies were able to come out very, very well, much better than this scenario here in terms of what the losses they had to pay out for business interruption during the COVID lockdown. So with policies, you see limits such as how many times you can claim in a policy, right? And at the same time, for every claim, what is the maximum that you can pay out? Certainly, reinsurance also plays a very vital role associated with it. Okay? But the important thing to point out right now is how there is now a significant change in terms of the clarity and the design of the policy wording and the design of the product. Okay, that ensures that a situation like this does not arise again. But here's the good news for mid-sized players in China. If you look at the auto insurance market in the United States, it has very similar characteristics to the US, to the China market when it comes to the competitive landscape. In the US, you have three big dominant players: State Farm, Geico, and Progressive. While in China, you have something very, very similar in the case of Ping An, PICC, and CPIC. So there's no question about it that auto insurance is an economies of scale play, right? While the good news with commercial insurance, right, it's more of a niche play. It's more the niche players who are able to create the most value in terms of profit than the larger players are. We can see this very clearly with AIG and CNA struggling, right, to deliver a lot of value or profit to their shareholders, while small regional companies like Cincinnati Financial and Erie Financial, right, are delivering a tremendous amount of value to their shareholders, even though they are limiting their scope of geographic exposure. They're only in the Midwestern part of the US. But the fact that they've been able to find those niche businesses, niche markets that are very profitable is what makes a very, very successful commercial business. Chubb is no different, but you can make the argument that Chubb is no longer considered a mid-sized player after it merged with ACE. But Chubb, before its merger with ACE, was also able to deliver a lot of value based on its niche, profit-driven underwriting focus. So let's talk about Chubb a little bit more. What you can clearly see here is Chubb being able to consistently outperform the market. Why is that? The reason is the commercial business model is completely different from the auto business model. The auto business is more about scale. It's more about not just economies of scale in terms of back office operations, but also economies of scale as it relates to distribution. With commercial, it is a different story. Commercial is an underwriting culture. The underwriters are the highest paid employees within a commercial organization. The chief underwriting officer is the number 2 or number 3 executive within the organization. And the focus is more about driving profit and complete avoidance of focusing on growth and market share. If the profitable business is not there, they will walk away from it. And that's the type of discipline that Chubb has put in place. And that is why they're able to achieve such results. Going back to small commercial, this was a survey conducted. And it's clear that the need for insurance by a small business is there. We strongly believe that if a similar survey was done in the China market, it will be no different. So it's just a matter of who is the right player who's able to design the right and implement the right value proposition for this market. Also, if we look at the product profitability, it's a completely different dynamic. The good news there is loss and LAE is a much smaller component of your total profitability picture, right, than you would expect in the auto market. But that's driven primarily by your distribution. But it's very important to point out when we look at the distribution figures here, it's very important to point out that we're talking about a different cost structure. What do we mean by that? What we mean is the bulk of the payments made for the distribution side are driven by the 3-year profitability of the book of business that the distribution brings in. Not volume, while volume has a factor, but the bulk of the payment is related to profitability. So they're only getting paid if you see these type of losses or better. If they're able to find you that niche market, if they're able to engage in the risk selection process to find you that better risk, given their local expertise, etc., right? That's what you're paying for, not volume. If we look at the property side, which includes homeowners, if you remember in the first slide that we looked at, fire was around in the US for hundreds of years. However, it's only in 1950 that you got a product like this where the coverage was wide, more than just fire insurance. And the actual building itself or the actual structure itself, right, is a smaller component of the overall value proposition. So why has a product like homeowners been much more popular and much more successful in countries like the US and Europe, but not necessarily China, at least yet? Well, there are two factors in our view that are driving that. I think number one is obviously from a regulatory perspective, a bank, if part of your home is owned by a bank, they require you to purchase homeowners insurance. So there's no question about it that regulation plays a big part in the popularity in this particular type of product. However, what's important to note is renter's insurance that is not mandated by regulation or anything and is a pure choice is also becoming very, very popular. So number one is the distribution side in the US has done a good job of convincing or building a case and building a product that the customer sees a lot of value in, regardless of whether or not it is mandated. Another campaign, a very, very successful campaign that I would like to bring to your attention is bundling homeowners with car insurance and providing the customer a discount has now become ubiquitous amongst all players in the US, given how successful this campaign was and given how attractive this was to a customer. Whether you're buying homeowners or whether you're buying renters, okay, receiving such a discount on your car insurance is a very, very attractive proposition. But why would an insurance company do something like that and eat away at their profits? Well, they're not really eating away at their profits, because if you look at the average number of years that an auto customer stays with a particular insurance company, it's around 3 years. When you add when you bundle another product like renters or homeowners, okay, the average number of years grows to around 5 years. So those 2 additional years where the insurance company doesn't have to market to get that additional revenue that it's lost through attrition is worth them paying that 20%. China is no different, where the average number of years that an auto customer stays with an insurance company will range between 1 to 2 years on average. And this could definitely be a very good way for insurance companies to start thinking about not only non-auto products, but ways in bundling those non-auto products. Now let's look at the property side and try to also look at its profitability, specifically the loss ratio. As you can see here, a major component, or more than half of your loss ratio, will be related to fire as well as wind and hail. We're going to talk a little bit more about how, when you're looking at underwriting and when you're looking at claims, how you need to invest in order to address this. But that is where your focus needs to be in terms of not only understanding your exposure in this area, but also how to contain or manage this risk. Then let's look on the liability side. There is no question that the number one factor for liability expenses is litigation. Here's an example of Hartford, where 35% of its claims end up in court. Again, the approach, of course, is to do what they can do to try to settle a claim and stay outside of court because of the delay that causes costs in terms of liability and setting up reserves, etc. However, 35% is actually a pretty good number. At some point it's unavoidable and you have to go to court. And by far that is your biggest driver of losses in a liability, either type of product or coverage. So in general, when you look at the two sides of a typical property and casualty product, what you will find is property damage tends to be more frequent, right? So it drives up your claims frequency. So from a claims frequency perspective, property products are higher, while liability products have a higher severity compared to property. And once again, we're using the example of Hartford and what their major costs are as it relates to claims. So now we want to take a step back and talk about two important components of your commercial business. Of course, there are several components that are critical, but we chose by far the two most important ones, which is underwriting, which we're going to talk about now, and then later on we're going to talk about claims. So as we mentioned earlier, with commercial products, you are dealing with an underwriting culture where underwriting can make or break your business. Hence, a lot of investment goes into your ability to underwrite a book of business. But the important thing is to understand that the underwriting process itself is highly distributed. What we mean by that, for example, let's start with distribution, right? You are looking for your distributor, be it an agent or of yours, or an independent agent, or a third-party broker, etc., to not only being able to bring in business for you, but more important than that is to be someone who's able to, or has the knowledge or capability to select good risk. This is someone who needs to be local to the environment, or local to the region, or local to the community, and really understands the risk exposure in this community very well, both geographically and economically, right? And is able to act as your eyes and ears in terms of identifying good risk. The second important task of this individual is to provide you with good data and good, reliable data that you can count on. Because as you're aware, on the commercial side, the availability of data is much less so than what you're able to get from auto insurance. And this is further amplified in China because commercial insurance is a new business, or where there's not enough data to understand where the exposures are. Then on from the distributor, we talk about the underwriter. And the larger the size of the coverage, or the larger the size of the business, the more you're going to rely on the talent and skills of the underwriter versus automation to make the right decision. We mentioned earlier about how underwriter talent is the most highly paid talent in the commercial space. And that's for a particular reason. Yes, there have been systems that have been built in the commercial space, right? And yes, it is more applicable to the small commercial side. But you're never going to get to a point where you are able to beat your competition unless you're able to find those underwriters that are savvy enough to identify where the good risk is and where those niche markets are and where there's less competition. Above the underwriter would be what we would call the portfolio manager. Okay, working closely with the actuary. This portfolio manager also looks at something just as important, which is concentration risk and the overall exposure to a particular product, be it across different regions or different products versus this current product that you're selling, and trying to understand how much exposure is the company's facing with these different products and these different regions that is being underwritten. Then next we get into the risk engineer and the importance of the risk engineer in terms of number one, being able to assist and help the field on identifying where the good risk might be. But also the larger the risk, the more they play a consultative role. Not only during the underwriting process to help a business understand what type of safety procedures they can put in place within their organization to help them preserve their assets, but at the same time help you as an insurance company manage your losses. Not only does that happen at the beginning, but on a continuous basis, especially with those larger books of business or larger commercial customers that you do business with. And last but not least is the actuary, and the actuary's ability to take such diverse and distributed and sometimes hard to collect data and to be able to make the right decisions around pricing. Am I underpricing the market, or am I overpricing in the market? And what can we do about that? Right? What are we looking at in terms of reserves? And what can we set for reserves? And how can we set for reserves for products that may be long tail or have a catastrophe associated with them, catastrophe exposure associated with them, et cetera, et cetera. the role of the actuary, once again, takes on a much more critical role in the overall underwriting and pricing process. So let's talk about how more sophisticated the job of the actuary, or more challenging the job of the actuary ends up becoming. So here you see, a typical actuarial triangle where you are based on historical information, looking at the actual predetermined values of your potential claims payout for a particular book of business, and looking at how it perpetuates itself over the years. And what you're trying to do is you're trying to square the triangle to understand what the outcome is going to be for the overall book of business, right? And using, or extrapolating, the cumulative numbers that you have been able to gather from the earlier portions of your book of business. Well, this type of approach is okay to consider when you're dealing with a shorter term risk like car property damage, or vehicle or personal lines auto damage. However, when you're now starting to deal with longer term tail risks, and with risks that may have an unexpected one-time loss due to a catastrophe or something similar, right? These models become less and less effective in terms of your ability to make such a prediction and set reserves, etc. So what you have here is what we call a deterministic model, right? Which is a model that is determined based on your assumptions or your predetermined data on that particular book of business, and you're simply extrapolating, right? So the question is, what happens after year 6, right? Or what happens if in the longer tail, right, the pattern of payout changes due to inflation, due to regulatory changes, due to change in societal norms, etc., so on and so forth, right? A deterministic model becomes less and less effective, right? More importantly, you're looking at numbers on a cumulative basis. And to understand, the deltas of cumulative numbers tends to be less and less telling of what to expect in the future. So more and more actuaries have turned to what we call stochastic model, which is you just let the data tell you, right, what are the predictors, okay, without you having any preconceived notions of what the results should or should not look like. And it's data down to the individual policy level that the machine is able to gather and identify trends and look for similarities across different groups of claims, and to try to do the prediction accordingly. So that's where you want to start thinking about when you're dealing with these more sophisticated type of claims, or that have longer tail or catastrophe exposure. But then there's a huge problem. Where are you going to get this data from? Right? The big challenge for China right now is this industry is young. The non-auto industry can be classified as still being young. there's not enough data out there, or there's not good data out there for you to be able to have that level of sophistication, right, in order to build the right model or a predictive enough model. So where do we go from here? We want to walk you through 10 steps to think about as you're looking to enter this market with new products where you don't feel that you have good data and you need to get started. How to get started? Well, number one, and I cannot emphasize it enough, is establish a test and learn process, okay? And be patient. What I mean by that is you have a very controlled test of that product, right? Where you are not concerned about growing that new book of business. You're simply looking to gather data over the course of, say, 3 years, 4 years or so, in order to clearly understand, okay, how to fine-tune this product in terms of limits, of exposure, in terms of pricing, etc., etc. And if, God forbid, losses are outrageous for that particular product, well, you have a very controlled environment and you haven't spent the past 2 to 3 years growing this book of business blindly, right? And giving yourself such large exposure. You have to be very, very controlled and patient in terms of seeing to it that when you get started, you give yourself this test period, right, where you have a very limited exposure until you gather good data. Number two, we talked about the importance of underwriting, and we talked about the importance of how your distribution or your local field individual who is bringing you that book of business, how that individual is able to provide you good, accurate, predictable information, and working with them to determine what that good information should be in order to start building your data and in order to start understanding better than your competition, hopefully, right? What the risk parameters of such a book of business is. Then there's a question of how do I determine whether I'm overpricing or underpricing compared to the competition? Well, with car insurance, it would be easy for you to go to your competitor and have one of your employees buy a policy from there and see what the pricing is, or look at regulatory data to see where their pricing is to do some sort of comparison. You're not afforded that luxury as much in commercial, once again, because it's a young market. And second of all, it's usually sold through intermediaries that may hold on to the data, like a broker, for example. Well, there's one way to do this, which is to look at your retention rate and what is called a strike rate. Strike rate is basically of those that you approve for underwriting, how many of them sign up for your product. So the idea is, obviously, if your retention rate is low, well, that could be good news, but it could be bad news at the same time, which means that you may be underpricing the market. Right? While if your strike price is very, very high, i.e. you're getting much fewer take-ups or people signing up for your product based on the numbers that you've approved, well, maybe you're overpricing the market, which may not necessarily be bad, but at least that's how you would gauge, am I overpricing or underpricing the market? The other one is you want to start somewhere. So is there a way for you to extrapolate from the data that you already have in order to start making sound assumptions? For example, if you have some property data, right? Maybe it's the data of an individual, or maybe it's a data of an individual who's starting his own business and it is in his or her home, right? Well, maybe that's where your starting point is. And then you can start making smart assumptions of, okay, well, maybe this is a business that has 1 to 2 employees. Now I can start extrapolating what it would look like for 3 to 4 employees and 5 employees. And you slowly start building your commercial expertise, starting with what you can extrapolate from. And as you start extrapolating more and more, you're gathering more and more data, and that will allow you to continuously expand your horizon in terms of the size of business that you can underwrite over the period of time. So your growth strategy, your expansion strategy, should be in line with this, where you're not only growing in certain markets for revenue purposes, but you're also growing in certain markets with the goal of you're evolving your knowledge of risk underwriting. And as this knowledge evolves, you're able to continue to expand in that particular type of market or type of segment. Obviously, reinsurance is a must. It is almost ubiquitous now, where most insurance companies have a limit tolerance in terms of how much exposure they're willing to be able to undertake when it comes to, especially when it comes to cat exposure. And then the remainder obviously is reinsured on a stop loss basis or an excess loss basis, right? So know what your limits are. What is the maximum you're able to assume when it comes to exposure, right? And understand where it is you need to, what beyond that you need to purchase in terms of reinsurance. We talked about policy limits and understanding where the limits are in terms of both frequency and severity, right? We talked about the example of, for a particular policy, a claimant is only allowed to claim once, or maybe once every 2 years. And then for every claim, there's a maximum cap in terms of how much you're able to pay out. We talked about the importance of machine learning and how if you're able to build a model that is granular enough to start looking at trends at the individual exposure level, individual policy level, etc., right? That's how you're going to be able to identify exposures as your data accumulates and grows. The next one is related to cat exposure again. It is very, very important to now start building the capability to understand weather patterns and to understand those regions that may have more exposure to catastrophes, and either in terms of frequency or in terms of severity. And that becomes a very, very important source of external information that you now need to start to accumulate, monitor, and analyze. We then talked about the importance of a risk engineer and even your distribution channel, right? Before the loss happens, how can they advise your customer to have the right safety procedures, to avoid a fire, etc., and to continuously check up on them and make sure that their smoke detectors are working, etc., so on and so forth, to see to it that this is an opportunity to contain any potential losses that may come out of this book of business. And last but not least is, once again, the importance of having a multidisciplined underwriting, pricing, and risk process. Not only you have your first line, right, which is your underwriter and your actuary, continuously looking, analyzing your portfolio exposure, and understanding your concentration risk or your regional risk or geographic risk, etc., so on and so forth. But you also now, as you're aware, you have 3 lines of defense. You use the second line, which is your risk team or your risk management team, to audit your underwriting and your actuary, and to provide a second set of eyes in terms of looking at that exposure again and sharing with you or debating with your first line in terms of are we properly diversified, or are we taking the right approach in terms of entering into new markets, or are there early signs of disaster that we're seeing from one product versus the other? So once again, your job is not going to be easy by any means. So the best advice I can give you is start small and be very patient and move slowly into this market. Now we want to shift over to claims. So you're probably very familiar with some of the main activities that we've highlighted here. But the ones that may be new, right, especially as it relates to more non-type products, is having a core competency around catastrophe management. We're going to talk about that, both in terms of before claims happen to begin with, and then also when a catastrophe happens, how can you react quickly? Litigation management, we talked about the more you get exposure to mitigation, the more having a core competency about managing the litigation process becomes more and more critical. Then there is reinsurance, and reinsurance specifically to avoid excess loss or excess exposure, right? It takes on more importance when you're dealing with property insurance. But in general, we talked a lot about loss cost containment, okay? Not only during the underwriting process, but also when a catastrophe happens. Not only do you have a catastrophe management team, but they're closely working with your engineers to also understand what more can be done. And last, and obviously not least, is your claims data is the wealth of information that you need, not only to manage your claims, but is the key information needed in order to feed back the loop of your underwriting and pricing process that need this information as some of the most critical information they need to improve their pricing process. Again, I can't emphasize enough how with commercial, you're no longer relying that heavily on external information that is readily available as you would in the personal lines auto. Here's a perfect example of a commercial property and casualty provider, a small player called FM Global, that is probably best in class when it comes to investing in its risk engineers and providing consultative loss control services to its clients. And in essence, being very, very proactive when it comes to not only avoiding or minimizing claims, but also when a claim's happening, minimizing the severity associated with it. The good news there is it's a double benefit. As you can see here, not only is it a situation where you're able to reduce your loss in LAE, but you're also able to improve customer satisfaction. These type of proactivity, especially in the commercial space, for a business owner, takes on much more importance. And if you're one of those organizations that is able to be best in class in this space, right, you will certainly see the benefit both in terms of your losses improving, as well as your retention and customer satisfaction and your ability to cross-sell. So here's a map of the US in terms of how significantly different property insurance pricing can be from one region to the other. You may or may not know this, but for example, Florida has a pretty high exposure to hurricanes. Louisiana has a fairly sizable exposure to floods. While in the Midwest, you tend to have more exposure to typhoons, or I'm sorry, to hurricanes that have a tendency to have a higher frequency but lower severity. While Florida, when a hurricane hits, okay, it's not as often, but certainly the severity is much, much higher. If I were to plot the map of China, it would be no different in terms of the geography and the topography of the land. Certain parts are more prone to earthquakes like Qinghai and the Tibetan Plateau, right? While others are more exposed to typhoons on the coast, etc. It is very, very important for you now to start to gather the intelligence to better predict, okay, what your exposure is by region, and to try to factor that in not only into your pricing, but also into how you're going to proactively manage losses in those regions, especially in the case of a catastrophe. So once again, just simply an example of how Chubb has built a system around that. Looks pretty rudimentary, looks pretty straightforward, but it's very, very effective. Okay? Chubb is continuously monitoring by region what their exposure is. A system like this is not very difficult to build, right? So build it early rather than later, and start building that intelligence, start building that database of knowledge in terms of becoming the first in the market to understand the climate impact on different regions of the China market. So what is the most valuable lessons learned in terms of managing catastrophe that is critical for China to learn from? Well, one of the most important events in insurance history was Hurricane Andrew that hit in 1992 in the US. And my apologies, we don't have those numbers here available, right? But this was the highest loss experienced by the insurance industry in the US ever at that time. 11 insurance companies went insolvent. And ever since then, catastrophe management has never been the same in the US. And it's clear that the insurance industry has learned from this. Here you see Hurricane Katrina is now the biggest loss ever in the industry, but insurance companies now have the capacity. They've been able to use reinsurance prudently. But more importantly, they've been able to continuously manage their exposure in this area. And two things or two capabilities that they developed that I want to talk about, that I believe that is critical to start thinking about and building now with the anticipation of any potential exposure like this. The first relates to weather modeling or catastrophe modeling, right? And this is a capability that takes years to build. But ever since Hurricane Andrew in 1992, insurance companies have been building this capability. And now, I believe every single insurance company with property exposure, especially in regions that are highly prone to major events, have developed this capability by now. So it's now a mature market or mature capability in the US. The other good news is weather patterns are global. And you have the opportunity through your broker, international broker, or international reinsurance provider to have them help you build this capability or help you provide those services in terms of understanding weather patterns and understanding potential for catastrophe. And you're using this information for pricing, for reserving, right? For understanding your capital adequacy, liquidity, etc. It goes into multiple factors. So what are the main components of this type of weather modeling? Where there are three main components that you're trying to predict. First, you're trying to predict the probability of an event happening. What type of event? Okay. How severe is that event going to be? Right? And how often, or 1 in 10 years, 1 in 50 years, etc., so on and so forth. With that information, then you're trying to look at, well, what type of damage will this cause, right? Where am I exposed? What type of materials are going to be damaged? What type of damage is it going to be, etc., so on and so forth. And last but not least, obviously, is what type of loss am I going to see, okay, based on my limits, okay, based on my exposure, etc. What does that translate into in terms of losses? And obviously, you're doing stress testing where you're looking at worst case scenarios versus most probable scenarios, okay? And net result is that helps you with your reinsurance decisions. And as mentioned, helps you with several other areas, including reserving, pricing, product development, etc., etc. Then this concept of having a dedicated team that are experienced and knowledgeable in terms of handling catastrophes. I would like to show you where the US market is. You won't necessarily start here, but at least you can think about where you want to be in the future. So as you can see, the example that we used here is Allstate. Okay? 800 dedicated individuals. okay, that are full-time individuals, all state employees that are part of the national catastrophe team. They're the ones who immediately go out there, hand out checks, okay, help residents move out, have a team of electricians or plumbers, etc., okay, that they work with in that particular region, etc., and help the customer. So not only are you looking to mitigate your risk, but obviously it is an opportunity for you to provide incredible customer service and potentially have these customers for life if you're able to do this right. Here's the good news. Now you have an opportunity to enter a sector where you can lead the market in terms of profitability and value creation. You have an opportunity to find those underserved markets, niche markets that the big players are too busy or too stretched out to reach out to. And you are the one who's able to make profit and provide superior service in those niche markets. Just one thing that I would really like you to get out of this course is this is one area, and as you've seen from the data that you see here, where if you chase market share, it will come back to haunt you. Do not make market share gain or revenue growth your target in these types of business, especially if the more you're getting exposure to large losses through catastrophes or longer term risk. If there's one thing only I want you to get out of this course, it's number 2. Number 3, hopefully through the short discussion, you are now convinced that commercial isn't simply an extension or a department, okay, within your auto business. Right? This is a different business model. This is a completely different culture. Okay? Treat it that way. Treat it like a separate business. Treat it like a separate culture. You have completely different hiring requirements, skills requirements, system requirements, distribution requirements that it warrants to be treated as a completely separate business model, not just an extension of auto insurance. Certainly, you can leverage your distribution channel that you're using for auto insurance to sell these type of products, especially if you're in the smaller commercial type of business. But once again, the support and the skills that you're looking for in those who are distributing that product is completely different than what you're asking them to do to sell auto insurance. I believe that not only is there an opportunity to make profit in the small commercial space in the near future, I believe this opportunity exists for the very, very long term. As you can see, the US market geographically is similar to China, right? Where there are a lot of these areas of the market that may be rural, that may be underserved, etc., even with a mature market like the US today. So even with a highly competitive market like the US, you are still able, as a niche player, to find those pockets of communities, geographies, products, business types, where you can take a leadership role. And the profit opportunity, the investment opportunity for you here is not just for the near term. I believe it's for the very, very long term. We talked about evolution, and certainly if you look at how a big personal lines insurer like State Farm got onto the small commercial business. It is very similar to what's happening in China right now, which is their auto business got very competitive and it was difficult to make a profit out of it. Their agents were looking for more opportunities to make commission, right? And their customers that they were selling to in the rural communities were small business owners demanding certain type of coverages. So slowly but surely, they started to get into this business. And now State Farm is the #1 underwriter of commercial insurance for small businesses between 1 and 15 employees. So you as well can go through this evolution and, as mentioned, continue to collect data in this space. And through this test and learn process, you're not only expanding your relationship with your customer and underwriting more profitable products, but you're learning more and more or collecting valuable data to continue on your journey of expanding in the commercial space. And we've mentioned this several times, but it's worth mentioning again. You are dealing with a completely different skill set when it comes to underwriting, pricing, and portfolio management. Who you recruit and who you train and what the reporting structure that you have, right, is unique to the commercial market and certainly is different from the personal lines auto insurance market. And last but not least is, as you get into more exposure, longer tail risk, catastrophe exposure, the role of creating a 3 lines of defense, especially a second line of defense, that is able to provide a second set of eyes to audit and provide a different point of view on your risk exposure in this space takes on more and more importance with these type of businesses. So this brings us to the end of our presentation. I want to first of all thank you for listening, and we hope that you found something useful on your journey. We wish you best of luck. Certainly, my exposure to the China market, the China insurance market, has been nothing short than impressive. You have outstanding talent, you have outstanding drive, and I am very, very optimistic that the China market will not only be the largest insurance market in the world, but the most dynamic and innovative. And once again, we wish you continued luck and success. And thank you again for your kind attention.